Ever since I started my career, there's been a big debate on active versus passive management. And if we're being honest, the numbers don't look so good for active managers. In this video, I'm going to tell you the two reasons why active managers are struggling to outperform and what they can do to fix it. There's actually a simple fix. But before we get into the video, I would love it if you could just take 2 seconds to hit the subscribe button below. Our YouTube channel is pretty new, as you guys can see, so seeing that subscriber count go up really encourages us to keep making new content that you guys enjoy. Okay, let's get into the video. So as I mentioned, active managers have really struggled to beat their benchmark, and it's only gotten worse. If you look here, from the early 2000s to about 2010, it was about a coin flip. So that was when I started my sort of interest in finance, and I remember the active versus passive debate was heating up. And, it was, are you going to take this coin flip or are you going to invest in the S&P 500 ETF? But now, the last 10, 15 years, the number of large cap managers, according to the S&P, underperforming their benchmark is close to 70% on average. If we look at 2024, it's about 75%. So it's about a 20% jump in the last 15 years compared to the decade prior. So something has clearly changed for performance for active managers to deteriorate this much. And that's what we're going to talk about today. There are two reasons that we want to isolate. The first reason is that growth has slowed. And this starts all the way up at the economy level with GDP growth. This slow growth then filters through to companies. So if we're going to start on the left here, we see US real GDP growth quarter over quarter. The average for these different time periods, you can see in the 80s through the 90s, we were at 3.7% growth. And then leading up to the global financial crisis, that had fallen to about 2.5%. And then since the global financial crisis, we are at 1.7% growth. So really slow growth across our economies. And as I mentioned, that filters through to companies. So if we look on the right, the number of S&P 500 companies with long-term sales growth over 15% has fallen dramatically since the year 2000. We had over 200 at the start of this chart. At the low, we were close to 50, and that since has come up a little bit, and we're now sitting just above 90. But there are just not that many fast-growing companies in the S&P 500 right now. And so why is that a big deal? Well, first, let's just confirm the relationship, and then I'll explain. So if we look at this dot plot here, as you can see on the x-axis, we have the companies with long-term sales growth over 15%. And then on the y-axis, we have the percent of active managers beating their benchmark. And as you can see, the more companies that are growing over 15%, the higher percent of managers that are beating their benchmark. So why does this relationship exist? Well, when there are fewer high growth companies, portfolio managers are playing in a smaller pool. So all of them are buying the same names. So all of these portfolio managers, all these investors, the number of stocks that they're considering to buy is just a much, much smaller number. There's less options for stock pickers to dominate. So this is an environment where macro dominates. Every large cap manager is investing across a very similar small group of stocks. So those who can position themselves correctly throughout the business cycle, as the business cycle ebbs and flows, will outperform those who can't. Unfortunately, not a lot of investment managers know macro. Learning and understanding macro is a great way to differentiate yourself as an investor. As you can see here from this chart, stock picking in this slow growth environment just isn't cutting it. So let's get on to the second reason, and that is that holding periods have shortened. And they have shrunk dramatically. In the 1960s, the average investor held an investment for over 8 years on average. In 2024, that number is down to less than a year, 0.6 years, which is about a little over 7 months. Now, let's talk about this from a higher level. This makes sense. The longer an investor holds a stock, the less important macro is, and that's because you'll just be holding it throughout entire business cycles. So if you're holding it for 8 years, you're probably going to be holding it, at least one full business cycle, if not more. So the timing of when you're buying that stock compared to where you're at the business cycle is just less important. However, if you're holding a stock for 7 months, what the economy is doing at that time becomes incredibly important for your performance. So let's walk through 2 different examples that illustrate this point. So first, we're going to do holding the S&P 500 for 8 years. All right, both of these charts show 8 years holding the S&P 500. So that's what it was like in the 1960s. On the left, we have starting from January 2008. So that is right before, if you look, the stock market fell dramatically in the global financial crisis. And then on the right, we have a holding for 8 years a year later in January 2009. So that was almost bottom ticking the market. So obviously, if your manager perfectly timed this and got you in the market on January 2009, fantastic, awesome. Obviously, the one on the right is preferred. However, the point being, both of these were profitable trades. So even if you invested right before the market collapsed, if you held for 8 years, it did not matter as much as you will see on this next chart with on the next slide, when you have a much shorter holding period. A long holding period mitigates the impact of the business cycle on stock selection because you're holding it over multiple business cycles. So let's look at short time periods. So we're not even going to do the 7 months here. We're going to do 1 year. And we're going to start from those same dates. So this chart on the left, same thing, starting from January 2008. So, bad timing, obviously. The 1 year holding period during that slowdown would have got you negative 38% returns. On the contrary, if your manager almost timed it perfectly, a 1 year holding period would have got you positive 23% returns. So the only difference here is when you entered the market. A short holding period magnifies the impact of the business cycle on stock selection. Your investment manager needs to have an understanding of where we are at in the economic cycle when holding periods are shorter. And again, unfortunately, not a lot of investment managers have a strong understanding of macro, and that explains why the number of large cap managers underperforming has been so elevated over the last decade. And that is why we created the macro specialist designation. It is a 2-level professional designation program teaching everything we just talked about. Level 1 is the required level that gives you the basics. And then there are 2 options for level 2. Path A is more of a traditional portfolio management approach. And then path B is more quant. So you can tailor your path here based on what your interests are. If you're looking for a way to stand out, if you're looking to buck this trend of active managers underperforming, I highly suggest you check out our program. And that's what I'm going to leave you here today. I appreciate you watching this video. If you did enjoy, I encourage you to subscribe, and a link to our designation program will be included in the description of this video. Have a great week, everyone, and I look forward to seeing you guys soon.